it was a strong quarter for Deutsche Bank. Our revenues were up 10%, led by FIC and also our asset management business, up 17 and 18% year on year, respectively. But we see momentum across the businesses, and we think that'll carry through for the rest of the year. We're also maintaining expense discipline, and so we beat on both of those lines, had a very strong pre-tax and after-tax profit of up 39%. And our ratios are in line with, frankly, better than the targets we set for this year. So an ROTE of nearly 12% and a cost-income ratio of just over 61% really give us a strong step off that we were looking for into 25. On the credit loss provisions, we actually came in close to guidance. And what I mean is that the stage 3, so the provisions for non-performing exposures, came down as we anticipated they would, and a normalized view of stage 1 and 2, so provisions for performing exposures, was also more or less in line. What we did, though, was put on some overlays to reflect the unusual environment that we're in and really anticipate potential sort of drift of the macroeconomic variables. We think that's prudent and appropriate, but where we land for the year will depend very much on the macro direction.
Let me ask you a little bit about this direction, because clearly the market is not overly convinced that you can meet your targets. So what's the message from your side? Of course, you'll tell me you'll meet them, but how are you going to achieve that?
Well, listen, most years we've had this experience of closing the gap between ourselves and consensus expectations, and in most cases where management expected the years to fall. And certainly we're looking for that to happen again in 25. Look, there's lots of things we don't know about the future. We're obviously dealing with a lot of uncertainty on the policy side at the minute, but we also have some certainty. For example, on net interest income, we've hedged away really almost all of our interest rate risk for 25, so we feel very confident about the path on net interest income. What we think of as our predictable revenue sources, especially in the private bank, performing very well. We see the momentum there to be strong. We also think that a corporate bank will pick up momentum as the year goes by, and some of the policy changes, particularly in Germany, on the fiscal side, and that's feeding into confidence, flow through. There is uncertainty, obviously, in financial markets. For some of our businesses, like FIC trading, that can be a good thing, and the first quarter showed that. For some of the businesses, like the corporate finance wallet, as you've seen from some of our competitors, we need corporate confidence really to come back.
Yeah, it is. It is actually, I think, stunning to see how corporate confidence falters so quickly, because at the beginning of the year and also towards the end of last year, everybody was thinking this year will be the year of big M&A, this year will be the year of big IPOs. So how is the pipeline doing, and do you think that it will come eventually?
We do. I mean, the pipeline's up year on year. As with our competitors, you've heard, our pipeline is strong, and we're actually quite confident about the impetus to transact, whether that's capital raising, M&A, obviously the IPO market. But it requires essentially confidence about the markets you're pricing securities offerings into. It also requires some confidence about valuation, whether that's in the M&A context, buyers and sellers agreeing prices, but also in that context, if you are buying or selling, the policy environment in which you're operating is obviously an important consideration for long-term investments. And so that's having the effect of chilling activity a little bit. But it doesn't mean that those transactions go away. Very often they're just put on hold for a period of time, and when the market circumstances are right, they'll take place, and obviously it translates into revenue for the banks.